If you've been an investor for any decent length of time, you've probably fantasized about what it would have been like to buy stock in companies like Amazon, Apple, or Microsoft before they got big. The embarrassment of riches that would have been yours even with only a small investment is incredibly tantalizing. However, most of us don't ever have that experience of investing in the next big thing before it gets big and then staying invested in it long enough to reap the rewards that we're fantasizing about. Now, that's not going to stop us from fantasizing about it, of course, because, let's face it, as long as we're not beating ourselves up over something we had no reason to believe we would have done anyway, it's fun to run the numbers and see what could have been. But that's not the scenario that intrigues me the most. No, the scenario that intrigues me more is a practical one, because while we aren't super likely to find and invest in the next Amazon before it gets big, that doesn't mean that we can't still benefit from investing in those mega giants after they become gigantic. Hypothetically, what would happen if someone simply invested all of their money into the 5 largest companies in the stock market? What would their returns look like? How would they fare during bear markets? Would the sheer size of the companies that they're invested in protect their capital better than if they had invested in a wider array of companies? And what about their ability to come back from downturns that they do experience? Larger companies often tend to have more cash on hand and income than their smaller counterparts, and it's not uncommon to see them simply acquire competitors in their niche, especially during those down times. Does that ability allow them to emerge from a crisis stronger or faster than their competition? Or would we be better off sticking with a more broad-based approach? That's what we're going to be finding out today. Let's talk about investing in the mega giants. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So for this video, we're going to be comparing the performance of a hypothetical investor, John, who puts all of his money into the 5 largest companies in the stock market by market capitalization, against the performance of another hypothetical investor, Jane, who puts all of her money into a Vanguard S&P 500 index fund. We'll be grading the performance of their investing strategy in a wide variety of metrics, including, but not limited to, their returns, volatility, start date sensitivity, downturn performance, and ability to recover from those downturns. For John's scenario, we'll be starting in 1996, since that's the earliest year for which I could find complete data on the largest companies by market cap without having any gaps in between. And we'll have him check in on the markets once a year to determine which 5 companies are the largest, and then he'll split his investments between those 5 companies equally. For the sake of simplicity, we'll assume that all investments are being made into a Roth IRA or 401k or something similar, so that taxes are not a concern. With that being said, let's get started by analyzing the growth of these strategies. When it comes to measuring returns, I like to split them up into 6 different categories to get a better idea of the full picture. They are the average, median, minimum, and maximum returns, and what I call the baseline and stretch returns, which are just the returns of the 20th and 80th percentiles respectively. This gives me a good idea of not only what is typical, but what the extremes tend to look like, and what range I can expect the majority of my returns to fall into. For John's investment strategy, he would have had average and median returns of 9.6% and 11.6% per year respectively. His best and worst returns over the past quarter century would have been 72.5% and negative 43%. His baseline and stretch returns were negative 0.6% and 25.8%. Jane's investing strategy into the S&P 500 produced a little bit lower returns than John's at 9.2% per year on average. But the median return was a little higher at 12.8%. Jane's worst 12-month stretch would have seen her investments fall by 43.3%, while her best stretch would have seen a 53.7% increase in the value of her nest egg. Her baseline and stretch returns were negative 0.3% and 21.9% respectively. So based off those figures, we can gather that the typical return for Jane was slightly higher than for John. But since John's strategy produced much better returns during those best years, with roughly equal returns in the worst years, John's average return was actually a little better. However, returns aren't everything. If we add risk into the equation and look at the Sharpe and Sortino ratios of the strategy, the winner becomes a little clearer. Despite having slightly higher average and maximum returns and the ever so slightly lower minimum return, the S&P 500 actually beats out the mega giant strategy in both the Sharpe and Sortino ratios. The S&P 500 had a Sharpe ratio of 0.47 and a Sortino ratio of 0.97 during this time frame. The Mega Giant approach had a Sharpe and Sortino ratio of 0.43 and 0.89 respectively. The reason for this is simple. Of the two strategies, the Mega Giants approach delivers less consistent and dependable returns. The standard deviation of returns for the S&P 500 during this period was 16.8%. For the Mega Giants, it was 20.6%. Beyond standard deviation, we can also look at the investment's skew and excess kurtosis values to get a better idea of the shape and consistency of returns. Skewness will give us an idea of the shape of the returns when put into a histogram chart. A negative skew suggests that the majority of returns we get will be above what the average would suggest, with a few of those returns coming in considerably below the average, dragging that figure down. A positive skew suggests the opposite, that the majority of returns are actually going to be below what the average would suggest, because there are a few incredibly large returns that are dragging the average up. Since 1996, the return distribution of the S&P 500 has had a negative skew. So has the Mega Giants approach. They clock in at negative 0.9 and negative 0.92 respectively. Bitcoin is an example of an investment that has, so far, had a positive skew, though it has also been incredibly more volatile, so there's that. The metric can be particularly important for investors with shorter time horizons, since they may not have the ability to wait out the volatility of an investment during a decade like the 2000s, for those returns to come back in line with what the long-term averages would suggest. It can also be an interesting insight for investors who are particularly risk-averse. If an investor feels like they're likely to shoot themselves in the foot and sell when the investment is down a lot compared to where they thought it would be based on average return figures, then selecting investments with similar return and volatility figures but a more positively tilted skew might work out better for them in the long term, as the incredibly surprising returns are historically more often going to be above average in that case. Excess kurtosis tells us a little bit more about those extremes and surprising returns. Specifically, it helps to give us an idea of how common they are by comparing a distribution of the returns to the normal distribution or bell curve. If there are more extreme outliers than what we would expect to normally see in a bell curve, then the excess kurtosis value will be positive. If the extremes are less frequent than they would be in a bell curve, the excess kurtosis will be negative. If it's stability we're looking for, then a negative excess kurtosis value is ideal. However, as with all financial metrics, excess kurtosis shouldn't be viewed in isolation. Just because there are less extreme outliers than what we would expect to see in a normal distribution doesn't mean that that distribution is narrow. To give an example, the S&P 500 and Mega Giants approaches both had negative excess kurtosis values. The S&P 500 scored a negative 2.3, the Mega Giants a negative 2.71. This actually suggests that relative to a normal distribution, the Mega Giants approach had fewer extreme outliers than even the S&P 500. But as we just saw with the return distribution in the previous section, and the standard deviation a minute ago, it actually had a wider range of historical returns. So as we can see in terms of consistency, the S&P 500 does tend to hold an edge. It has a standard deviation that's nearly 20% narrower than what the Mega Giants approach produced, with similar levels of skewness. And while the Mega Giants approach had less extreme outliers relative to a normal distribution, it likely isn't enough to make up for the fact that it has been much more volatile under the much more frequent normal circumstances. Dependability is another important thing to consider when looking at an investment, and the main ways I tend to measure this is with start date sensitivity. I've covered start date sensitivity extensively on this channel already, so I won't spend too much time on it today. But the basic idea is that we compare the trailing returns of an investment over a certain period of time. I've often used 10 years, but since we only have 25 years worth of data to go off of today, I'm going to shorten it to 3 years, to the returns of that same investment for the following period to see how big of a difference there is between the two. For instance, if an investment had average annualized returns of 15% per year from 1990 to 2000, and average returns of negative 5% per year from 2000 to 2010, we'd say that it had an underperformance of 20% per year during that time period. We repeat this process for every possible starting date that we can and calculate the difference between the largest overperforming period and the largest underperforming period to get our total start date sensitivity. Generally speaking, the lower the total start date sensitivity is, the better, as it suggests that the returns you get from the investment are less dependent on you getting lucky by investing or selling at the right time. Assuming we were looking at 3-year return windows, then the total start date sensitivity for the S&P 500 during this time frame would have been 84%. The megagiants was a little bit higher at 88%, suggesting that its slightly higher average return figure is a little bit more dependent on luck than the S&P 500, but not by a huge amount. So that just about does it as far as analyzing the returns. But beyond growth, it's important to consider how investments handle themselves in tough times. After all, an investment growing at 20% for 5 years before falling 50% is still going to come out behind an investment that's growing at 10% per year for 5 years before falling 20% in a down year. So how tranquil are these investments? How often do these strategies lose money, at least on paper? And how big and variable are those losses? Finally, how long does it take for the investment to reach its low point? Well, based on this data set, the S&P 500 loses money on paper roughly 19% of the time, which is slightly better than the megagiants, which loses money 21% of the time. The S&P 500 loses at least 10% of its value in 13% of cases, compared to 16% for the megagiants. And the S&P 500 enters crash territory by falling at least 20% in 7% of all time periods, compared to 10% for the megagiant approach. So in other words, during this time frame, the S&P 500 and megagiant strategies tend to lose money about once every 5 years on average. When they do lose money, the S&P falls by at least 10%, roughly 2 out of every 3 times, and by 20%, roughly 1 out of every 3 times. The megagiants fell by at least 10% nearly 3 out of every 4 times, and by 20% almost half the time. As far as variability of downturns goes, it seems that, once again, the S&P 500 holds a small edge over the megagiant approach. When every downturn is taken into consideration, the average depth of a downturn at its worst was about 7% below the previous peak for the S&P 500 and about 9% below for the megagiants. The standard deviation for those returns was 8.3% for the S&P 500 and 9.9% for the megagiants. So there's more variance to the average downturn, and the downturn tends to be a little bit more severe for someone investing purely in the largest companies over the last 25 years. Given this, it should also come as little surprise that the worst downturn during this time frame also favored the S&P 500, when it fell by as much as 51% during the Great Recession, compared to the 61% drop suffered by the megagiants. As far as duration is concerned, the megagiant strategy actually might hold an edge here depending on what type of investor you are. On average, it took around 2 months for the megagiant strategy to hit bottom after the downturn began, compared to just 1.3 months for the S&P 500 as a whole. If you're an investor who's still in the accumulation phase of your journey, this may actually be a good thing. For one, it's possible that a slower fall might be easier to stomach than a quicker one, assuming the point at which the investment bottoms out is the same. Now that might just be me, so let me know if you feel differently here, because I'd be interested to hear where everyone stands on this and why, but I think that an investment that falls by, say, 20 or 30% over the course of a year is easier to stick with than an investment that falls the same 20 or 30% over the course of a month or two, kind of like what happened in 2020. In the end, it's still down by the same amount, but the slower burn might provoke less of a visceral emotional reaction, and thus lower the chances that an investor would shoot themselves in the foot and sell the investment when it's down. But again, let me know where you stand. Another, more measurable reason that this might be a good thing for an investor in the accumulation phase of their journey is that it allows them to buy the dip for a longer period of time, which will help accelerate their journey to financial independence once the investment bounces back. Now granted, in this particular case, we're talking a difference of less than a month on average, but these are also 2 investments that are fairly similar, being that they are both large cap US stock strategies. Depending on the investments that you're comparing, you might see a much larger difference. With that being said, it would seem that the S&P 500 is, on the whole, the more tranquil investment. It loses money on paper a little less frequently, and when it does so, those losses are generally not quite as large or quite as variable. This is reflected in the megagiant's downside capture ratio relative to the S&P 500 of 109. For those who don't know, a downside capture ratio is a financial metric that seeks to illustrate how good an investment is at preserving capital relative to a benchmark, in this case the S&P 500. when that investment is losing money. The ratio is also fairly commonly used to get an idea of how good an active money manager or investor has been at the same task. The ratio is fairly simple to calculate. All you have to do is take the return of the investment, say it fell by 12% for the year, and divide it by the return of the benchmark during that same time. Say it also fell, but only by 10%. And then you multiply that result by 100. In this case, we'd get a downside capture ratio of 120. A downside capture ratio of over 100 suggests that when the investment loses money, it tends to lose more money than the benchmark did during that same time. A score of less than 100 suggests that the investment was better at preserving an investor's capital during rough times than the benchmark. Lastly, let's talk about resiliency. Because as we've seen when we've examined the historical performance of cash as an investment, all the tranquility in the world is not going to amount to much if it takes an eon to recover from every minor downturn you do experience. The resiliency of an investment can be measured in many ways, but for today, we'll focus on the time it takes to fully recover from a downturn once the investment has bottomed out, and how much of the investment's time is spent in either correction or crash territory, defined here by how often it's at least 10 or 20% below its previous highs. As far as recovery time is concerned, the megagiants did actually hold a small lead. On average, it takes the megagiant strategy 1.9 months to recover from a downturn after bottoming out, compared to 2.7 months for the S&P 500 as a whole. This is impressive considering that the average bottom of a downturn for the megagiants was actually worse than for the S&P 500. So it's recovering faster even though the S&P 500 is essentially getting a head start. This also means that the total average downturn duration for the S&P 500 and megagiant strategies are almost identical at 3.6 and 3.7 months respectively. However, it does seem that the megagiants approach has historically meant spending a considerably larger portion of your time in either correction or crash territory. The megagiant spends roughly 58% of its time at least 10% below their previous all-time highs, and 51% of its time at least 20% below those highs. Compare that to the S&P 500, which spent roughly 35% of its time in correction territory and 22% of its time in crash territory. Despite all that, though, the megagiants still managed to narrowly out-earn the S&P 500 during the last quarter century. That's because when things were going well, they were going really well for this approach, illustrated by the megagiant's upside capture ratio of 121, which is calculated the same way as the downside ratio, except only using timeframes where the megagiant strategy was posting positive returns. And unlike the downside capture ratio, a score of over 100 is a good thing, as it suggests that when the investment grew, it grew more than the benchmark. This also means that it holds a total capture ratio of 110, calculated by dividing the upside capture ratio by the downside capture ratio. This suggests that the megagiant's ability to outperform the S&P 500 during good times was more than enough to make up for its inability to preserve as much capital during rough times, at least over this time period. So there you have it. Taking a more focused approach to investing in large cap companies like John did with the megagiants may indeed yield larger returns, however narrowly it was in this case. But those returns may not be as consistent year to year or as dependable over the long haul. And it turns out that it actually might make your investing journey more stressful, with more frequent and larger downturns. And even though those downturns are typically recovered from quicker than they would have been with a more diverse approach like Jane's S&P 500 index strategy, you're still spending more of your time looking up at those previous highs. So I know there wasn't a huge difference in a lot of these metrics, but I was interested to see what would have happened if someone invested in just the largest companies on the market in any given year. And it gave me a good excuse to discuss some more of these financial ratios that I haven't really gotten too much of a chance to cover before, like the skewness of the returns or the capture ratio. Those metrics can give us a little bit of a better insight into what investments are right for us depending on our risk tolerance and goals. So I thought it'd be a good thing to cover. But what do you think? Are there any other ways that you evaluate your investments? Let me know in the comments section below, and also, let me know where you stand on that whole fall duration topic. Would you prefer an investment that takes longer to bottom out and then recovers quickly, assuming that the severity of the decline in the end and the total time it takes to go from previous highs to setting a new one was roughly the same? Or would you find that slower burn approach draining and just want to get it over with, even if it means the recovery portion of the cycle took a bit longer? It's a very philosophical topic, and I'm genuinely curious to see where people stand on it. So let me know. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.